traders? Welcome out to your Maverick Currencies midweek update for November 30th. Hope you had a nice holiday weekend, and let's get to it. As always, a quick reminder to make sure that you follow your trading plan. Not a whole lot has changed over the past couple of weeks. When you kind of look at the markets, we're in this bit of a holding pattern, I would call it. Equity markets have been pushing a little higher. US dollar's been pushing a little lower, and those have had certainly some inverse correlation. So as the US dollar has weakened recently, that has fueled, it's been a factor, probably a fairly significant factor in fueling stocks in the opposite direction. So one would anticipate that if the dollar moves sharply, then it's going to impact equities. Now, this is not a correlation that's like perfect day to day. If the dollar goes up 0.5%, does the S&P go down 0.5%? No, it doesn't work that way. It's more about the directional move. Will tend to move inverse right now, and it's more about the aggressiveness of it. If the dollar just chops around, then the equity market's probably going to somewhat chop around, and equities could even kind of chop but move up or something like that as the dollar flattens out. So it's if the dollar makes a big move, then you anticipate something bigger happening in other markets accordingly. Again, the dollar coming off of its highs really had a nice kind of exhaustion set up and then a downturn, and now we're in that tricky spot where it's just bouncing around, and it's a little harder to make heads or tails of it. I don't have a strong opinion personally in the short term where I can't really pound the table and say this is a great opportunity. We'll look at it, but it's a little bit of a wait and see mode. Crypto continues to struggle, a little bit of a bounce back in some of those markets over the past week or so, as they were kind of left for dead, but ultimately it's going to be a zero for most of the NFTs and tokens and all those sorts of things. Will there be a few that survive? Quite possibly so. And I mentioned this a couple of weeks ago that if you are the ardent believer, the believer that Bitcoin is the future, et cetera, well, a couple of weeks ago was where, as a long-term investor, you'd almost have to buy. The old saying, when there's blood in the streets. Well, FTX collapsing and that downturn it really is that type of criteria. And Bitcoin has bounced a little, not a lot since then, but it's trying to stabilize. My personal opinion is that they're going lower still, that I don't think Bitcoin and those assets have hit their lows. That's the way I would see it. Economic reports, GDP out of Canada, basically flat at 0.1. It met expectations. Not strong by any means, and that's a month-over-month number. If we skip down here to U.S. GDP, quarter over quarter up 2.9%. So a little bit of an uptick in the US. Inflation in Australia lower than anticipated. And this has been something that has fueled a little bit more upside in the Australian dollar and specifically the New Zealand dollar as those CPI numbers are coming in lower than expected and concerned about. That's generally good for your currency from the standpoint of you can kind of look at it as they're maybe not fighting the same battle that other countries are, and their CPI is coming down a little bit more aggressively. Maybe that will be better for their economy and so forth. The flip side of that, however, is, well, what do you do when CPI is high? Well, you raise rates, you slow things down, which tends to be kind of the rate differential. If they're raising rates, that should be good. So it's not clear cut that a low CPI has to help your currency. There's sort of a good news, good news, bad news scenario with that. And then ADP employment, which always comes out the Wednesday before Friday's non-farm payrolls. So non-farm payrolls are the first Friday of the month. ADP comes out the Wednesday before, and it came in and missed at 127 versus 196. Again, that one's a little bit of a bad news. Is good news potentially for equities in that if the jobs number is worse than expected. So the Fed's not paying as much attention to ADP as they are to the non-farm payrolls. But if you are looking at it from the standpoint of if the payrolls come in this Friday worse than expected, the Fed's going to be less inclined to aggressively hike rates and so on. So that's a situation where, again, that's how markets work. Is you kind of have to look at the derivatives of it. Well, the number comes in weak. Well, the derivative of that is what happens with the Fed. And the Fed says, okay, we've got a weaker employment picture. We don't want to, burn that to the ground. We want people to keep their jobs and so on. So the Fed, remember, they have two main mandates: to keep full employment and to keep price stability. That's their two jobs. They've lost it on the price stability, and that's why they're going so hell-bent on raising rates, is they've screwed up. They've screwed up price stability, and they let inflation get away from them, and they're saying our other mandate, which is jobs, is fine. If jobs start to weaken, then they could get a little bit nervous that, hey, maybe we're doing too much over here. We can calm it down, hopefully keep the job number under control, get inflation under control, and now we've got our two mandates covered. So they don't want jobs specifically. They would care less about GDP and all those sorts of numbers. They care much more about the jobs because, again, that's their two mandates: is full employment and price stability. It doesn't have anything to do with GDP. It doesn't have anything to do with all those other things. It's price stability and jobs. So those two are intertwined. As we look at this week, so far this week, the equity markets in the US, it's kind of funny. They're selling off on the China news and some of these other factors where China's booming. The Chinese equity markets are up about 10%. And that was a perfect kind of bad news is good news situation where it had all been priced in. People panicked early this week seeing the riots and the different things happening in China where people are upset about what's happening, with them basically locking people up and not allowing for freedom and such. And because of that, when you kind of look at it, it was priced in that Chinese equity markets had already started to recover, and sure enough, they're booming higher. The reason that US equities might be concerned is companies like Apple, which are so important to the broader markets. It's the biggest company in the S&P 500. Well, they've got direct correlation to Apple because that's where they get their supplies from. And so lockdowns and those sorts of things, they've already warned that they're not going to have as much supply of iPhones and other materials. And so they're not going to be able to sell as much. And, this is a problem in terms of the the near term, the next quarter or two. So it's interesting that, there's that reaction. However, what's happening in China actually makes it that much more likely. Not that China's going to flip a 180, but they are going to ease off, and they're going to basically, the people have spoken and they get nervous about, a repeat of Tiananmen Square and so forth. They're not going to say they screwed up, but they are going to ease off a little bit, and they're going to try to calm the masses. And so it was a situation where actually people out there in the streets in China makes it that much more likely that things are going to open up. So I would look at it as good news because we already knew there was those problems, but now they're more likely to be alleviated more quickly. And so Apple and these other stocks being down on the China news, I think is a bit of a buy opportunity in that if you're selling because of China, I think you've got it wrong. Let's put it that way. Now, if the markets go down for other reasons, fine, but that was at least part of what's fueled equities to the downside. Crypto markets bouncing, and oil specifically bouncing nicely this week. So let's go take a look at a few charts here. If we look at equities, we have really a couple of different factors in play. And I've mentioned this before. when I teach support and resistance and trends and all those sorts of things, I really use a big fat line. I don't talk about support and resistance as if it's this perfect number. Like for example, down here, if you look at these lows that the market hit down here, I would say it held the lows. Now, why would I say that? If I do a big marker across here, it did gap below it for one period, but it actually rebounded to stay above. This was the old support. Did it gap down here? Yeah, but it finished up here. That was the day where it could have broken support. Some people look at it as like this flat line, and they panic when you pierce that line. So if you draw a flat line here, you'd say, uh-oh, right here, markets broke support. And I don't look at it that way. I think it's a mattress. It's like a squishy area. And normally you do squish into these areas, these important areas. Everybody can see that low. Every single person that charts the S&P 500 and trades the markets sees that low. And so where do they put their stops? They'll put their stop loss right underneath it, and the market will trigger those stops every single time. You've got to give the markets some leeway that way. And in fact, I call it a kind of a false move or a squish into support. It's perfect for trading because usually when you kind of squish into support, you'll have a big spring back. From false moves come fast moves. In fact, we squished in, we even gapped below, and everyone panic sold. And then by the end of the day, we were up above, and that was the bottom. And that sort of dynamic just plays out over and over again. So if you think the market doesn't know that it can fuel the final sellers to capitulate and throw in the towel with just a little squish below support, you better believe they do. And so it was natural that it was going to kind of do that. We talked about that earlier this year with the US dollar. Remember when the US dollar first went up to its peak? We said it'll probably pierce its head above. It'll have that little false move, and then it'll come violently the other way. And for that couple of weeks, I traded the US dollar. It was probably my best period of time in the FX markets. It was picturesque. It moved violently back down. It was just easy trading because from the reversal, and you don't have to stick your neck out there. You don't have to buy as it's kind of squishing into support. Wait for it to show that it's kind of bouncing off of the mattress, right? If you're on a trampoline, it's not a flat board. The trampoline squishes down and then it shoots you back up, doesn't it? And so wait for you to kind of be bouncing back up before you jump in. Or if it's a resistance, same thing. Well, the reason I bring that up, if you were to drag a trend line down these highs, it's really pretty instructive. And this isn't going to be a perfect trend line, but it'll get you in the general idea. And I'm going to make it really thick because the same concept, what I think is going to transpire is I think the S&P has another push to the upside here in the short term. And what do I think is going to happen? Well, I would anticipate that we're going to squish up where most people think we're breaking through the trend line and this 200 period moving average. You see the 200 period moving average here underneath. I think we squish above and then we probably get the sharp reversal back below. I would still lean towards thinking there's that one push that goes and triggers all those stops. It's everything in trading is somewhat of a battle, right? You've got buyers and sellers, you've got some demand and supply. And in order for the markets to stop going up, basically you have to be hit with more supply than demand. So the question is, how do we exhaust the demand, the buyers? And the perfect spot is basically, who's the final buyers? Well, it's usually the people that are on the wrong side of the trade. It's the stop outs, right? It's people that are short that are getting stopped out. That's the final buyers. That's the last of the demand. Where can you stop out all the buyers? Just right up at these right above, frankly, these technical levels. You poke your head above that 200 period moving average and that downtrend line and so on, you're going to trigger stops, and you're going to trigger that final wave of buyers that give up, that throw in the towel. And it's when those buyers give up on that head piercing move above, then we can play the reversal. As you reverse, you'll usually do so in pretty dramatic fashion, and from false moves come fast moves. There should be a pretty swift and violent downturn that follows. So I don't think we've seen the end of this push. I think I mentioned this a couple of weeks ago that I'm waiting on an exhaustive type of move. I'm waiting on, this is the way I've painted the picture, and I'm still waiting on it. We haven't done much the last 2 weeks, but see this green candle here? That's kind of ish what I would expect to be the end of the move up here somewhere. That we kind of rally, and then there's that final push where it looks like you're breaking through levels and so on and so forth, and everyone gets bulled up and says, hey, the bear market's done, the lows are in, time to buy. Kramer will no doubt say, tell everyone to buy or whatever, and that's going to be the end of it. And so, I mean, I've traded these markets day in and day out for 20 years. I trade these types of dynamics, and they're just money. They're just opportunities. So, is there any guarantee we have to do it? No. We could always reverse too early or whatever, but my guess is there's enough emotion. This is the nice thing about bear markets. Bear markets are easier to trade because there's a lot more emotion involved. In a bull market, everyone's too complacent, right? The majority of the public isn't involved in a bull market. People aren't running around screaming with their heads, like a chicken with its head cut off. They're just ho hum. They look at their 401k, it's doing fine, they move on with their life. Emotions do get higher when you're in a runaway bull market. So certainly there was a lot of high emotion in Bitcoin and crypto's bull market because there you had greed and all those things highly elevated. You certainly have high emotions in certain bubbles, let's call it. Okay. But for the most part, a grinding bull market is not very emotional. It's more difficult to trade. In a bear market, we don't have that problem. There's so much emotion in these charts, down and up and down and up. And there's emotion tied into this right now. And I suspect, again, this is what I would anticipate. And you want to know where I'm going to get bearish, it's going to be on that type of dynamic. You get that final exhaustion phase where it looks like it's triggering the stop losses of the short sellers, etc., probably with a little bit of a piercing move above this 200-day moving average, above that downtrend line, etc. And that should put the finishing touches on this rally. Let's look at currencies. So pound and CAD down. CAD has really had a rough couple of weeks. It's still my opinion that I mentioned this a few weeks ago. I didn't really like energy, which had been the lone holdout for quite some time. I think I would pretty much be done with shorting the CAD here. It's not that it can't go lower, but it's really made a big move, and I would expect some corrective phase, something like that. So while the CAD has been a really good short, if you've been shorting it the past couple of weeks, we're seeing oil prices up like 4.5% this week. Now they have backed off a little tiny bit today, but I'm guessing that CAD is in the end stages of its current downturn. We'll look at that one. US dollars more difficult to trade. Swiss franc and euro still a little bit more bullish, and the Kiwi kind of surprisingly bullish. Crypto, not too much to add. I would say a little bit better price action this week and the past couple of weeks. It makes sense that buyers have kind of bid it back up because of the panic selling that was around FTX. Now, you're still in a deep, violent bear market, and I still think that they're going to go lower overall, but you got so much, you got just blasted with bad news. It really had to be the short term end to that downturn. So for us to rally, kind of consolidate for a couple of weeks, makes perfect sense. Is there another leg lower? That's what I would bet on. So let's go look at a few different things here. Let me come over and I'm going to pull up a couple of charts. I'm going to start with CAD because I think, so let's pull this over and I'm going to start with CAD. I think CAD is kind of instructive of, something that we want to kind of take a look at. Here's the weekly chart. It's been really, really selling off the past 4 weeks. But the reason I pulled it up on this time period is to show you the prior breakout zone. So it consolidated up here, it broke down, and it's just been violently moving lower. It probably could go a little bit lower. I mean, you can see it really hasn't kind of touched that. But actually, I'd expect we probably hit a bottom and we'll bounce, and then we'll have one more phase maybe to squish into that support. Let's look at it on the daily. And yesterday's price action on the daily in the CAD seems like an exhaustion low to me. What does an exhaustion look like? Well, you start a race usually with a big size candle and a key technical break, right? So here we broke support and it was a clean break. It didn't like squish into it and reverse or anything like that. I mean, that's a break. This one squished in and reversed. This one broke. Okay, so now we have a breakdown. And we go lower for the next couple of days and then break a little lower. But at the very end of the move, you'll often see I mean, it's not uncommon to see the biggest candle at the start of the breakdown and then the other largest size candle at the end of the breakdown, right? This is the start of the race and this is the finish line. And if you're running a race, that's the two spots where you get a jolt of adrenaline. You get a jolt of adrenaline when the starting gun goes off and you sprint out there. And then the middle of the race is kind of boring and you're just, grinding through it. And then you see the finish line off in the distance and you sprint for the finish. And that's what yesterday looked like to me. So yesterday to me was really an exhaustive kind of flush to the downside. It's trading against the chart to try to buy this. I mean, clearly you're buying an ugly, ugly chart. But as a short-term trader, I don't need it to go up much. But if it bounces for a couple of days, which I would suspect it will, there might be a tradable opportunity. You'd have to come in. I mean, all of these charts, downtrend, 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 you'd have to come into a really short-term chart to even see this kind of bounce that has happening. Uh, what would I do? Well, I always say I never buy breakouts that go counter to the trend. So I'm not really inclined to try to buy a break higher because you've got all this potential overhead supply. Instead, I would buy a pullback like we have right here. So are we making higher highs and higher lows on these little pivots? Currently, yes. Okay, a little bit higher high here than the prior high, a little bit higher low here than the prior low. I think we can buy this around, on this chart, I think we can buy it here for a little bit of a push to the upside, and it's a low risk, high reward type of proposition. What I would do is line up the CAD, and this is a little speculative, but again, remember oil prices tend to lead CAD. Look at oil. Okay, it's reversed out of what had been an ugly period. Oil had been down, 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 and it's starting to reverse. And I think that's the bounce we're starting to see in CAD and so forth. So if I come over to, and that's the daily chart, here's the hourly chart in the WTI and crude. Let's look at a couple of CAD charts as potential candidates. So here's CAD versus the Japanese yen. You could do that. It's actually a little better than the group. It's above these little short-term moving averages and has the pullback. You'd be buying here around 102.87, probably targeting a move up here. You know, you don't have to get crazy aggressive. I think we can go to 103.50 or so, and you're risking about 20, 25 pips to do it. Okay. You could buy CAD. Well, let's look at a couple others. Here's US dollar versus the CAD. USD I'm going to avoid, as I mentioned earlier. I just don't have a strong opinion on that one. Here's Euro versus CAD. I've been a little bit more, the Euro chart has been going up. It did have a little exhaustive type of move. Euro CAD did yesterday. Part of that it was CAD itself. If you wanted to short EuroCAD, I'm okay with that. Again, I wouldn't risk much on this idea. If you're shorting here, it's a short at 139.82, probably a stop loss just above 140. And again, you're risking on EuroCAD, you'd usually want to risk a few more pips because it moves so much. It's much more volatile than CAD yen, for example. It'll move more pips overall, but you'd probably put a stop up here above 140, something like that. So up above 140, again, you're risking 25, 30 pips, which on EuroCAD is nothing. Now, you might get stopped out of that quick, but it's a low risk, high reward type of proposition. Again, we're in a little bit of a bear rally, but I suspect another leg to the downside is what I would anticipate. So trying to short, probably, I could see waiting a little bit, make sure it pivots over or something like that, but it's basically a short in this area. I've been a little bit more optimistic on Euro, so I don't know that that's my favorite, but it still kind of fits. Aussie CAD I would avoid. Aussie's just been a little too strong. Same thing with Kiwi, and they're sort of correlated. And then last was Pound CAD, and this one I think you could go as well. Pound CAD probably shorting here at 161.74 ish. This one's a little more ready than like EuroCAD, which we were already in this bullish candle. Here you have a bearish pivot reversal, and this is just coming up to the midpoint of that candle. Pound CAD could be interesting. Again, tight stop above 162 is probably all you're risking, and you can easily get a down shot to 161 where you're risking, 80, or pardon me, your reward is about 80 some odd pips, 83 or so pips. So it's CAD looked interesting to me before I came on to class for that kind of exhaustion low. I think yesterday put in a bottom, and so today should be basically kind of an overlappy type of day if we think about it. What's the most common candlestick after a huge expanded range candle? So if this is big size, the most common next candle is what we call a harami, right? So if it's a bullish candle, usually the next candle will be a small one up here on the top half. If it was a huge bearish candle, which is what we have in CAD, then the next period's candle would usually be a harami, a little small candle on the lower half. So here, this is a red candle. This would be kind of just a little green or red or whatever candle in the bottom half. If you look at that CAD chart, we had the big exhaustion. Let me go back to that daily chart. Okay, see the huge candle? See the small candle that fits inside that's down here on the lower half? The reason this gives you a really good risk to reward for an exhaustion is basically this move was what wiped out, was basically the exhaustive move, right? Anyone that's willing to sell, they threw in the towel. They gave up. They capitulated, as we call it in trading. They just said, Uncle, it's too much pain. I can't take it. And so you flushed out the sellers. Now we have the inside day. You don't have to risk a lot. In essence, we shouldn't go back to that low the next day. Essentially, we'll probably finish around here, and then tomorrow it should build and have, I should draw that in green. Tomorrow it should build and have, maybe a mediocre. It doesn't have to be a strong candle, but something like this, and there probably would be a couple more, and whatever. You'll probably get an overall upward move over the next couple of sessions. What matters to us is this one right here. This is going to make or break our thesis for buying CAD. Now, I could be dead wrong about this, right? There's no guarantees that CAD bounces here over the next 12 to 24 hours and that the next candlestick is bullish and so forth. But that's certainly what I would anticipate, what I'm trading for. Other than that, I literally don't really have any strong opinions. I mean, if you look at everything else, I mean, Kiwi's been stronger than I would have expected, kind of coming towards the top end of that range. One would think that maybe we squish up into the zone and then it kind of pulls back, right? Kind of a little false or push into that resistance, into that mattress, and then reverse back, right? That certainly could be in play here. But there's not a lot that's really compelling to me. If I look at the US dollar chart again, I mean, it had that big downturn that we had talked about. I certainly was bearish on US dollar for a good sized correction. And now, I talked about this a couple of weeks ago, it's just pretty hard to be mega bearish or mega bullish on US dollar. And, probably the right call to just not do anything with it for right now, because that's a whole lot of choppy mess. So I'm not doing anything with USD currently. You'll probably break out of this range in the not too distant future. If equities are going to make another push to the upside, I would lean towards thinking that the US dollar would probably have a little bit of a push down here, and that might be the end of it for a while. Then US dollar can rally for a few weeks, and I think equities get hammered at that point. But that's down the road. That's, I think, a couple of weeks away. Equities, I think, are going to have that push, and so I'd lean more towards a bearish US dollar stance from that standpoint. Hope that makes sense. All right, here we go. So for the rest of this week, let's click on the calendar here. Tomorrow we'll have our currency recap as usual. It comes out on Thursdays. Friday, we've got non-farm payrolls. We're going to be trading that live. That will be at 8:15 a.m. Eastern Time, 6:15 Mountain. So we'll be trading that live together on Friday. And then, of course, this weekend, we'll always get out the FX Currency Room update. So thanks again, everyone. Have a great rest of your week. If there's any questions, anything we can do to help, never hesitate to ask. And we'll see you next time. Goodbye.